Now coming to the classification of taxation system. So how do we decide that how much will be the tax rate? So that is decided by the different method. So first method is proportional taxation, second is progressive taxation, and third is regressive taxation. Let us understand each one of them. So proportional taxation. So first one is the proportional taxation, right? So the name itself indicates that tax is levied in the proportion, that is as a percentage of the tax base, and important aspect is that tax rate remains uniform. टैक्स रेट नहीं बदलता, टैक्स रेट चाहे कम इनकम हो चाहे ज्यादा इनकम हो, टैक्स रेट सेम रहता है. सो टैक्स बेस रिमेन सेम इररेस्पेक्टिव ऑफ द साइज ऑफ द टैक्स बेस. तो एग्जांपल लेते हैं. हियर द परसेंटेज ऑफ टैक्स रेट रिमेन्स द सेम बट द एब्सोल्यूट अमाउंट ऑफ टैक्स इंक्रीजेस विद द इंक्रीज इन द साइज ऑफ टैक्स बेस. तो टैक्स रेट तो सेम ही रहेगा. जैसे कि इस एग्जांपल के अंदर टैक्स रेट इज 10% इन बोथ द केसेस, लेकिन जिस तरह से टैक्स बेस का साइज इंक्रीज किया, फॉर एग्जांपल अगर ये वैल्यू ऑफ गुड्स है, अगर वैल्यू ऑफ गुड्स 10,000 रुपीज है, उस पर हम टैक्स रेट 10% अप्लाई करते हैं, तो टैक्स का जो एब्सोल्यूट अमाउंट है वो 1,000 हो गया. अगर ये वैल्यू बढ़ जाती है 1 लाख रुपीज हो जाती है, टैक्स रेट विल रिमेन 10%, द टैक्स एब्सोल्यूट टैक्स अमाउंट विल बी 10,000 rupees. So absolute tax amount is increasing from 1,000 to 10,000. Tax rate is same and tax base is increasing. So with the increase in the tax base, the tax amount is also increasing. The tax rate remains the same. This is the feature of proportional taxation system. Next is progressive taxation. Progressive taxation के अंदर क्या होता है? In the progressive taxation, the tax rate increase with the increase in the size of the tax base. So, for example, if the size of the tax base is 10,000 rupees, the tax rate is 10%. If the size of the tax base is 1 lakh rupees, the tax rate is 20%. Normally, this is used for the income tax. So if the income of the person is 10,000 rupees, the tax rate is 10%. So the income tax ka absolute amount will be 1,000 rupees. If the size of the tax base is 1 lakh rupees, the tax rate is 20%. That is tax rate is increased. जैसे जैसे हमारा size of the tax base increase हुआ, हमारा tax rate भी increase हो गया और हमारा tax amount भी increase हो गया. और ये जो this increase in the absolute amount is high in proportion. It is more than the proportional increase. So this kind of system is used in case of income tax, and it brings equality in the society. Why? When the income of person is 10,000 rupees, that means the person is in low income category. The person is earning very less amount. The tax obligation will be less. If the person is having high income, that means the person is in the high income category. The paying capacity of the person has increased. So the tax can also be increased with the increase in the tax rate. So this progressive taxation system puts more burden on the rich person and less burden on the poor person. This brings redistribution of the redistribution of the economic resources in the society. So the more tax is taken from the rich people, and that tax is distributed in the poor people in the form of food subsidy, fertilizer subsidy, and different kind of subsidies, right? So this progressive taxation actually ensures equality and fairness in the economy. It brings inclusiveness because it benefits the poor people. it differentiates between the rich and the poor people. If the tax rate increases with the increase in the size of the tax base, it is called progressive tax. Progressive taxation helps to ensure economic equality in the society. Here the percentage tax rate as well as the absolute amount, right? So here you can see tax rate is also increasing from 10% to 20%, and absolute amount is also increasing from 10,000 to 20,000. It increases with the increase in the size of the tax base. So everything, tax base, rate and amount, all the three will increase, and this is called progressive. Why this is called progressive? Because this brings equality in the society. That is why this is called progressive. Opposite of progressive is regressive. In case of regressive, with the increase in the tax base, the tax rate increases. So this is completely opposite to the progressive taxation. So you can see over here, when the size of the tax base is increasing from 10,000 to 1 lakh rupees, the tax rate is actually declining from 10% to 5%, and the tax amount is increasing but less than proportional. So the change in the absolute tax amount is less than proportional. Why this is called regressive system? This is called regressive because it puts adverse impact upon the poor people, because poor people are also supposed to pay the same rate of tax as the other person. So if the tax rate decreases with the increase in the size of the tax base, it is called regressive tax. Here the percentage of tax rate decreases, but the absolute amount of tax increases with the increase in the size of the tax base, but less than that of the proportional and progressive taxation. So this is called regressive because increase in the size of the tax base actually decreases the tax rate. So this kind of system used to happen in case of wealth tax. In the wealth tax, if your wealth is very very high, your wealth tax rate will be low. If your wealth is less, then tax rate will be comparatively high. So the super rich people, they are supposed to pay less wealth tax, and the low rich people, they are supposed to pay high wealth tax. So this wealth tax has actually been abolished. So now in India we do not have the regressive taxation system, but still the goods and services tax, that is considered to be somewhat regressive. Why? Because in case of goods and services tax, all the people are supposed to pay the tax at the same rate. So for example, if on a mobile phone the rate of tax is 18%, so whether it is the Mr. Ambani who is the buyer of the mobile or some rickshaw wala, both the person will be supposed to pay 18% only. So this 18% remains same for the rich person and for the poor person. So the tax burden remains the same for both the person. It does not differentiate between the rich people and the poor people. So poor people end up paying more tax as compared to their income, and rich person, they end up paying less tax as compared to their income. So that is why this is called regressive taxation system. Now coming to the concept of effects of tax. So effects of tax, that means if government introduces some kind of tax, so either some new tax is levied or there is some change in the tax rate or tax base. In these two cases, how is the response of the society in general? This is called tax effect. So let us say for example, goods and services tax which was introduced. So goods and services was a new tax which was introduced on 1st of July 2017. As a response to this, there are many items on which the tax was introduced for the first time, right? And there were many items on which tax was abolished for the first time, and earlier there was a tax. So for example, tax on the wheat, tax on the raw wheat, that was abolished. So what is the impact of that abolishment? The impact is that there will be free flow of wheat from one part of the country to the another part of the country. Before the GST, the different states used to levy different rate of tax on the wheat. Now there is no tax, so the buying and selling of wheat can happen throughout India. The people can buy and sell based upon the price which is being offered by the farmer, rather than upon the tax rate which is being levied by the state government, right? So that is the response. So the wheat has become much more market based. The rates of wheat are much more closer to the market reality. So this kind of study of the effect is called tax effect. When a tax is imposed and collected, it elicits certain responses from taxpayer which have influence on working hours, savings, investment, etc. Such responses and their results are called effects. For example, if heavy tax is imposed on spending, people will save more to avoid tax burden. So this is another example. Now, tax elasticity. Tax elasticity means with the change in the tax rate, how much is the change in the tax revenue, right? So for example, recently the government changed, in fact government reduced the corporate income tax rates for few category of companies. So as a result, there will be two kind of impact. First, the tax revenue will come down, because earlier the corporate tax rate was 25% and now the tax rate is 15%. So revenue will come down because of the decrease in the tax rate. But some revenue can increase. Why that? Because of increase in the tax base. For example, in this case only, if corporate income tax is reduced from 25% to 15%, more foreign company will come to India because the rate of income tax is less. If more companies come to India, they will also start paying income tax to the government. So earlier they were not part of the tax base, now they are part of the tax base. So the tax base has increased with the decrease in the tax rate, right? So the impact of the change in the tax rate can be upon the total revenue in two different ways. So the study of this pattern is done so that the government can plan its resources, it can make its policies accordingly. So this tax elasticity helps the government in planning its own policies for the economy, for the foreign investment, taxation and other matters. A similar looking concept is tax elasticity, similar looking to the tax effect. It refers to changes in the tax revenue in response to changes in the tax rate. For example, how tax revenue changes if the government reduces corporate income tax from the 20% to the 25% indicates the tax elasticity. Now there is one more concept along with the tax elasticity. The concept is tax buoyancy. So what is tax buoyancy? So when there is increase in the GDP growth rate, this increase in the GDP growth rate will mean that tax base has increased. It is very natural. So if earlier the total income of the country was 100 rupees and now the total income of the country is 120 rupees. So earlier the tax was levied on 100 rupees, now the tax is levied on the 120 rupees. So definitely the value on which the tax will be paid is increasing. Very natural, right? I hope the concept is clear till now. Now, with increase in the GDP growth rate, what is the impact on the tax revenue collection? So, if GDP is growing by 10%, whether tax revenue is increasing by 5% or 10% or 15%. If it is increasing by 10%, that means that there is a tax buoyancy of 1. If it is increasing by 5%, that means tax buoyancy is 0.5. If it is increasing by 15%, then this is 1.5. Normally, for any country, tax buoyancy of at least 1 is desirable. So tax buoyancy should be at least 1. That means with the increase in the growth rate, that is increase in the national income, there should be corresponding increase in the tax revenue collection. So if there is corresponding increase, that will reflect that tax system is efficient because it is able to collect more amount from the same people in case the income of the people increases, right? So this indicates efficiency of the tax department and tax structure also. This indicates how much compliant people are. This indicates how much relevant the system is, whether the system is proportional or progressive or regressive. So tax buoyancy, it refers to responsiveness of tax revenue growth to change in the GDP. How do we calculate? Tax buoyancy is calculated by this formula. It is equal to proportionate change in the tax revenue, that is percentage change. So for example, the percentage change is 10% divided by proportionate change in the GDP. Suppose this is also 10%. So tax buoyancy will be 1. Tax buoyancy will be percentage change in tax revenue divided by percentage change in GDP, and this is 1. So normally tax buoyancy up to 1 is considered to be okay. This tax buoyancy can be either automatic. Automatic means the government did not do anything. The growth rate increased and tax increased. Very simple, right? That is tax buoyancy. Or it can be because of some changes introduced by the government, which are called discretionary changes. So these changes can be either change in the tax rate, or maybe the government has covered more number of people in the tax system. So change in the tax will lead to change in the tax revenue, and change in the coverage means bringing new group of economic unit into the or leaving existing group, right? So this increase or change in the tax revenue can also happen either through change in the tax base or through change in the tax rate. So as compared to tax elasticity, this tax buoyancy is in response to the change in GDP, and tax elasticity is in response to the change in tax rate. So this is the major difference. Here tax elasticity helps in forecasting the tax revenue and deciding the policy accordingly. The tax buoyancy it helps assessing the efficiency of the government's overall tax system, right? So this is the difference between the tax buoyancy and tax elasticity. Now there are two concepts. One is the impact of tax and another is the incidence of tax. So this is impact of tax and this is incidence of tax. So we take fees from you, right? So we are an institute and you are a student. So we take the fees from you, for example 10,000 rupees plus GST at the rate of 18%. So GST comes 1800. So we take this GST from you, right? The government of India has actually levied this GST on us, and we are collecting it from you, because ultimately we will shift the burden to you. So you are paying to us and we are paying to the government. In this case, the impact of GST is on the institute, and the incidence is on the student, right? So institute is the first point where the tax is being levied. It is legally obliged to pay the tax even if the student do not pay the tax. Or in other words, when it is collecting the fees from the student, it is the responsibility of the institute to collect the taxes also and deposit this tax to the government. So the legal obligation lies with the institute. However, the financial burden is being borne by the student. So ultimately, the student is under the financial obligation to pay the tax. तो स्टूडेंट की जेब से पैसा जाएगा, लेकिन जमा कौन करेगा? जमा करेगा इंस्टीट्यूट. सो इंपैक्ट है इंस्टीट्यूट पर और इंसिडेंस है स्टूडेंट पर. दिस इज द कॉन्सेप्ट ऑफ इंपैक्ट एंड इंसिडेंट. So you can see over here, the impact of a tax refers to the first point of levy of tax. It is upon those who bear the first responsibility of paying it to the authorities. So in this case, institute is responsible to the authority, to the government. The incidence of a tax refers to the final resting point of the tax. It is upon consumer to pay the taxes. So in this case, student is the consumer and student is the final resting point. Now, there are two kinds of taxes. One is the direct tax. For example, income tax. And another is indirect tax. For example, the goods and services tax. So we have direct tax and we have indirect tax. In case of direct tax, the incidence and impact remain on the same person. So for example, my income is rupees 1 lakh and my income tax obligation is rupees 10,000. This 10,000 rupees, first of all, I am obliged to pay to the government, and secondly, I will not collect this income tax from someone else, because this is income, this is tax on my income. I have to pay from my own pocket and I will not collect it further from some other person. That is why this is called direct tax, because this is directly levied on same person who will bear the ultimate burden. So the person who pays that tax to the government and the person who bears the financial obligation of the same is the one and only person. They are not the same, they are not the different person, and the person cannot shift the burden of tax to another person, right? In case of indirect tax, for example, goods and services tax. So the example which I gave you over here, the student is paying to the institute and the institute is paying to the government. The impact and incident is on two different person. The impact is on institute, but incident is on student. And institute is able to shift the burden of tax to the student, right? So when this shifting is possible, then this is called indirect tax, because the tax is being given by the institute, but indirectly it is being collected from the student. So we have both direct taxes and indirect taxes. Normally, direct taxes are progressive and indirect taxes are regressive. Normally, this is the condition. So there are two types of taxes. One is direct tax and indirect tax. So direct tax, the taxes for which the burden of the tax falls on the entity that is being taxed are known as direct taxes. In other words, the entity that directly pays this kind of tax bears the burden and cannot shift the tax burden. The direct tax are levied on the income, property and wealth, right? So the shift of the tax burden is not possible. My example, which I gave in the previous slide, that I earn 1 lakh rupees, I pay 1000 rupees. So I have to pay and I have to bear the burden both. Indirect taxes, those taxes for which the tax burden can be shifted. So the institute has shifted the burden to the student or passed on to the other person later through business transactions of goods and services. These taxes are indirect because the agent who bears the burden of tax is not one on whom the tax is normally levied, because the institute is different from the student. That is why this is called indirect tax. Indirect taxes include custom duties, goods and services, etc. So primarily direct taxes can include income tax, corporation tax. Corporation tax means the income tax which is levied on the corporate's profits. Income tax means the income tax which is levied on the personal income. Property tax, the tax which is levied on the sale and purchase of property. Inheritance tax, the tax which is levied when someone inherits the property from his or her own forefathers. Gift tax, which is levied on the gift transactions. Wealth tax, which is levied on the wealth which is held by you. The indirect taxes can be in the form of custom duty. That means taxes on the import and export of goods and services. Excise duty, that is taxes on the manufacturing. So custom duty means taxes on the import and export. Import and export. Excise duty means taxes on the manufacturing. Service tax means the tax which is levied on the services. This tax has been abolished after the introduction of the goods and services tax, GST. Sale tax, this has also been subsumed into the GST. And VAT is also subsumed into the GST. So now primarily we have GST and excise and custom duty in some cases. We will discuss each one of these taxes in the subsequent slides of this session. So you can see over here the difference between the direct taxes and the indirect taxes. So take 2 minutes and read this slide completely. Then you will come to understand the difference between the two. So I hope the concept is clear. I have discussed everything in detail. Now let us discuss the different taxes and income tax. The name itself says personal income tax, right? So normally personal income tax, normally we hear the term income tax or personal income tax, right? So income tax is the very, it is the overall term, and inside the income tax we have personal income tax and corporate income tax, right? So personal income tax is a category of the income tax, and corporate tax is also a category of the income tax only. This corporate tax is also called corporation tax. So many times you will read corporation tax, that is also part of the income tax only. Coming back, income tax, it is tax on the personal income of individuals, Hindu undivided families and partnership firm, etc. So this is on the income, and this is the direct tax. So all these are the direct taxes. In India, it is levied through the Income Tax Act 1861. So that tax law is more than 160 years old, and now we are talking about bringing a new law, that is Direct Tax Code 2010. So since 2010 we have been trying to bring a new law, but that law has not yet been brought. Corporate tax, it is levied on the company's profit. There is no separate tax called corporate tax. It is also income tax, but the contribution of tax from corporate to the income tax is large. So if we see these corporations, the corporations pay huge amount of tax because they also earn huge profit. Normally, if we see the budget figures every year, in the budget the corporate and the income tax both are given. Corporate tax are little bit higher than the personal income tax. Then third is capital gain tax. So what is capital gain tax? So this capital gain tax happens when there is sale of some property, right? This property can be in the form of building, real estate, gold. It can be in the form of share of a company, bonds of a company, government bonds, etc. So how do we calculate capital gain? Suppose we are selling a house. The sale value of house is 1 crore, that is 100 lakh rupees, and we purchased this house originally at 20 lakh rupees. So this 80 lakh rupees is the capital gain. This is the capital gain, and on this 80 lakh rupees we will be levying the income tax, because this is the income of the person. This 80 lakh is the income on the sale of property. So we will be levying the income tax, suppose at the rate of 20%. So income tax on the sale of property comes 16 lakh rupees. So such kind of income tax which is levied on the sale of property, this is called capital gain tax. So this is part of the income tax only. This is part of the personal income tax or corporate income tax. If the property is being sold by the corporation, then this is part of the corporate tax. If the property is being sold by the individual, then this is part of the personal income tax. So this is already a part of either one of these two. Why this is called capital gain? Capital basically means property. Gain means the profit, and tax means income tax. So capital means asset, gain means सेल पर जो हमें प्रॉफिट हुआ है, और टैक्स मीन जो हमने टैक्स हमने प्रॉफिट के ऊपर लगाया है. सो दिस इज हाउ यू कैन ब्रेक डाउन दिस कैपिटल गेन टैक्स.